Close the other tabs. Turn off notifications. This isn't background content. Right now, if you try to buy physical silver, not a futures contract, not an ETF share, not a claim on metal, you're paying somewhere between $9 and $12 over the spot price you see quoted on financial websites. That's not a premium. That's not a markup. That's a signal. And the spread is widening. The official story is simple. Temporary supply chain friction, elevated retail demand, normal market volatility. That explanation worked 6 months ago. It doesn't work anymore because what's happening now isn't a demand spike. It's a clearing failure that's being papered over with price divergence. And when clearing fails, convergence becomes mandatory. The only question is whether it happens through price adjustment or delivery default. Here's what we're walking through. Why the paper price and the physical price have decoupled, why the decoupling is mechanically unsustainable, and what forces convergence back. Not predictions, not speculation. Just the way settlement actually works when the assumptions behind it stop holding. I've spent 15 years watching how markets behave when liquidity assumptions break, not from a trading desk, from risk infrastructure, the place where you see what clears and what doesn't before it becomes a headline. And what's happening in silver right now is a textbook example of a market that is still pricing as if normal conditions apply, while the settlement system underneath is already in stress mode. Let me explain one thing clearly before we go further. Liquidity and price are not the same thing. Price is what shows up on a screen. Liquidity is whether you can actually transact at that price and size. You can have a stable price with evaporating liquidity. That's not a contradiction. That's exactly what happens right before price becomes meaningless. Think of it like this. A store can keep the price tag at $5 while the shelf stays empty. The price didn't move. The clearing stopped. Now, here's the narrative you'll hear publicly. Silver demand is elevated due to industrial usage, particularly in solar panels and electric vehicles. Mints are backlogged. Retail buyers are stacking. These are all true, but they're not the cause of what's happening. They're cover for what's actually breaking. The real story is about the shape of the futures curve and what it means when physical metal stops flowing into COMEX warehouses at the rate the contract settlement system assumes. Hold that thought. Let me walk you through how silver markets normally work, the version that's been stable for decades. You have spot price, which is the theoretical price for immediate delivery. You have futures contracts, which are agreements to deliver metal at a specific date. You have authorized participants and market makers who arbitrage the difference, keeping spot and futures aligned. And you have warehouse inventory that acts as the buffer, the physical metal that makes good on delivery when contracts expire. That system works perfectly as long as three things hold true. Warehouse inventory stays above a certain threshold. Basis relationships between spot and futures stay within historical ranges. And most importantly, physical metal keeps flowing into the warehouse system to replace what gets delivered out. Here's the fragility. The entire pricing mechanism assumes that physical silver is abundant enough that anyone holding a futures contract can, if they choose, stand for delivery and actually receive metal. That assumption allows the vast majority of contracts to settle financially, in cash, not metal, because everyone believes they could take delivery if they wanted to. The moment that assumption breaks, the financial settlement system loses its anchor. Now, look at what's been happening since last autumn. COMEX registered silver inventory, metal that's available for delivery against contracts, has been declining, not collapsing, not vanishing, just steadily declining. At the same time, open interest in futures contracts hasn't declined. It's stayed elevated. Do that math. Fewer ounces available to deliver, same number of contracts that could theoretically demand delivery. The market makers who normally arbitrage this, who buy physical, sell futures, collect the spread, and keep everything aligned, start facing a different calculation. If physical is getting harder to source and if delivery demand is rising even slightly, the cost of running that arbitrage trade increases. They need to hold more inventory. They need to pay higher premiums to secure metal. Their capital gets tied up longer. At some point, the spread has to widen to compensate for that elevated risk and cost. Here's where it turns. The spread is widening, but it's widening in the physical market, not in the futures market. Futures prices are still trading as if warehouse inventory is abundant and delivery is frictionless. Physical prices are trading as if supply is constrained and delivery is uncertain. That's a divergence. And divergences don't persist in commodity markets. They resolve. Now, the assumption that broke. The system relied on most contracts settling financially because physical demand was predictable and modest. But something changed in the past 18 months. Industrial buyers, particularly in Asia, started preferring physical accumulation over futures exposure. Solar manufacturers, battery producers, electronics firms, these aren't speculators. These are entities that need actual metal for production, and they've quietly shifted from just-in-time purchasing to building inventory buffers. At the same time, central banks in several emerging economies have been diversifying reserves into physical commodities, including silver. Not headline amounts, not disclosed amounts. Just steady, size-consistent buying that doesn't show up in retail news but absolutely shows up in available float. Put those two flows together, industrial stockpiling and sovereign accumulation, and you get a structural bid for physical metal that does not go away when price rises. That's the opposite of what the futures pricing model assumes. The model assumes price elasticity. If price goes up, demand falls. But if the demand is coming from entities that need metal for production or strategic reserves, price sensitivity is much lower. They keep buying. So now walk through the internal calculation, the kind of scenario analysis that gets run quietly in risk meetings. Baseline condition: COMEX registered inventory is currently around 70 million ounces. Open interest in active contracts represents roughly 600 million ounces of notional exposure. Under normal conditions, delivery requests run at about 3 to 5% of open interest. That's manageable. That's what the system is built for. New condition: delivery requests tick up to 8%. Not a surge, not a squeeze. Just a modest increase driven by the industrial and sovereign demand I just described. At 8%, you're looking at roughly 48 million ounces demanding delivery over the next 3 contract cycles. Registered inventory can handle 1 cycle, maybe 2, but it can't handle sustained elevated delivery demand without new metal flowing in to replenish what's delivered out. Here's the non-linear outcome. As registered inventory declines toward 40 million ounces, a level that's still technically adequate, market makers start pricing in delivery risk. They start widening the spread between what they'll pay for futures and what they'll charge for physical. That spread widening is what you're seeing right now in the retail market. It hasn't fully shown up in institutional pricing yet, but it will, because the entities providing liquidity to the futures market are the same entities that have to source physical metal when delivery gets requested. This is where the math stops working. If physical premiums rise to $10 over spot and futures contracts are still settling near spot, you create an arbitrage. Buy futures, stand for delivery, sell physical, pocket the spread. That sounds like free money, but it's not free if you can't actually get the metal. And it's not free if taking delivery locks up your capital for 60 days while you wait for settlement. And it's definitely not free if everyone else sees the same arbitrage and starts demanding delivery at the same time, which drains registered inventory faster than it can be replenished. That's the liquidity trap. The moment enough participants recognize that physical is trading materially above futures, delivery demand spikes. But the system can't handle a spike in delivery demand without either 1, physical premiums widening further to choke off demand, or 2, futures prices rising to close the gap. Either way, convergence is forced. Now let's talk about the feedback loop, because this is where controlled stress becomes disorderly. Imagine a dam. Normal flow, everything's fine. Flow increases 10%, still fine. Flow increases 20%, engineers start monitoring. Flow increases 30%, and now you're not just managing flow, you're managing confidence. Because the moment someone downstream doubts the dam will hold, behavior changes. They start moving, they start pulling resources, they start protecting themselves. And that protective behavior accelerates the very outcome they're trying to avoid. Silver markets are facing the same dynamic. As long as everyone believes they can get physical metal at a reasonable premium, most participants are comfortable holding paper exposure, futures, ETFs, allocated accounts. But if enough participants start doubting the convertibility of paper into physical, they shift their holdings. They demand delivery. They pull metal out of the system. And that withdrawal reduces available inventory, which validates the initial concern, which triggers more withdrawal. We're not in full feedback yet. We're in the early stage where sophisticated participants are quietly adjusting. They're raising premiums. They're extending delivery timelines. They're requiring prepayment for physical orders. These are all signs that the system is tightening, but they're being presented as operational adjustments, not structural stress. That framing works until it doesn't. Here's the split reality you need to understand. There are now effectively 2 silver markets operating simultaneously. There's the futures market, where price discovery happens based on financial flows, leverage, and sentiment. And there's the physical market, where price discovery happens based on actual availability, delivery timelines, and counterparty trust. Those 2 markets are supposed to stay aligned through arbitrage. But arbitrage only works when capital is abundant, delivery is frictionless, and trust is high. Right now, none of those conditions fully apply. Paper silver, futures contracts, ETF shares, unallocated accounts is still trading near spot price because the structure of those instruments allows cash settlement. You don't need physical metal to close a futures position. You just need liquidity in the contract itself. As long as trading volume stays robust, price can stay stable even if physical availability is constrained. Physical silver, bars, coins, allocated storage, is trading at significant premiums because availability is constrained and delivery is uncertain. When you buy physical, someone has to actually source metal, ship it, verify it, and transfer title. That process has friction, and right now, that friction is increasing. The narrative will claim these are separate markets serving different purposes. That's true in normal times, but it's false in stress. Because the futures market's credibility depends on the belief that contracts are convertible into physical. If that belief erodes, financial participants start demanding delivery to verify that their paper claims are backed by real metal. And the moment delivery demand rises, the physical shortage becomes visible in the futures market. Convergence is unavoidable because you cannot maintain a persistent arbitrage gap in a commodity market. Either futures prices rise to reflect physical scarcity, or physical premiums compress because new supply enters the market, or the delivery mechanism breaks and settlement shifts entirely to cash. Those are the only three paths. Let me be explicit about the outcomes. One path is impossible. Physical premiums compress back to normal levels, while futures prices stay unchanged. That would require a sudden surge in available supply or a collapse in physical demand. Neither is happening. Industrial demand is structural. Sovereign accumulation is strategic. Retail demand is persistent. Supply from mining is inelastic. It takes years to bring new production online. Recycling flows are insufficient to close the gap, so convergence through supply increase isn't on the table in any realistic time frame. The second path is disorderly. Delivery defaults start occurring. A major market maker fails to deliver metal on time, or a large ETF discloses that its physical backing is lower than stated, or a futures contract settles in cash because registered inventory falls below deliverable thresholds. Any of those events triggers a confidence collapse. Participants rush to convert paper into physical. The system can't handle the surge. Prices spike, trading halts, and regulators step in to manage the fallout. Probability, maybe 15-20%. Not likely, but not negligible. The third path is managed convergence. Futures prices gradually rise to reflect physical scarcity. Market makers quietly widen bid-ask spreads. Delivery timelines extend. Premiums stabilize at a new, higher level. The adjustment happens over quarters, not weeks. It's painful for leveraged shorts and disruptive for industrial users, but it doesn't break the market structure. The system adapts. This is the path we're on. Probability, 70-75%. But here's what that means practically. If you're watching silver because you hold it, because you use it, or because you're trying to understand commodity market stress, you're watching a repricing event unfold in slow motion. The spot price you see quoted, currently in the mid-20s per ounce, is not the price you'll pay for physical. It's the price at which financial claims trade. Physical metal is trading $10 to $12 higher. That gap will either close through futures rising or physical compressing. Given supply-demand fundamentals, futures rising is the more likely path. So what do you watch? 3 indicators. First, COMEX registered inventory. If it drops below 50 million ounces, delivery risk becomes acute. Market makers will start pricing and stress premiums across the board, not just in retail physical. That's when the divergence becomes visible in institutional pricing. Second, open interest in near-month contracts. If open interest stays elevated as contracts approach expiration, delivery demand is rising. That means participants aren't rolling positions forward or settling in cash. They're standing for delivery. That's a direct signal that convertibility concerns are increasing. Third, ETF flows. If large silver ETFs start seeing sustained outflows while physical premiums stay elevated, that's participants exiting paper exposure in favor of physical. It means trust in the paper to physical conversion is eroding. It's a precursor to the feedback loop I described earlier. None of these are panic signals. They're monitoring points. You watch them the way engineers monitor a dam during high flow, calmly, continuously, ready to adjust if thresholds are breached. Now zoom out. What's happening in silver isn't unique. It's part of a broader shift in how markets are treating physical assets versus financial claims. We've spent 2 decades in an environment where financialization worked, where paper claims were seamless proxies for physical goods, where leverage was cheap, where liquidity was abundant. That environment is changing. Capital is more expensive. Counterparty risk is more scrutinized. Physical possession is more valued. Silver is just early in showing the strain because it's a small market. Global annual supply is only around 1 billion ounces, and a significant portion of that is already committed to industrial use. It doesn't take much incremental demand to stress the available float. But the same dynamics are building in other commodity markets. The same divergence between paper price and physical availability. The same questions about delivery and settlement. This isn't the end of financialized commodity markets. It's a recalibration. Markets are relearning that physical and financial aren't perfectly substitutable, that leverage has limits, that liquidity can evaporate faster than price adjusts. Those are old lessons. They're being retaught now. Here's where we are. The $10 premium you're seeing in physical silver isn't noise. It's not temporary. It's not irrational. It's the market's way of pricing in delivery risk, supply constraints, and the gap between paper liquidity and physical availability. The premium will either compress because futures prices rise to meet it, or it will widen further because physical supply tightens more. Compression through futures rising is the more likely path, which means the official price of silver is going to adjust upward over the next 6 to 12 months, not because of speculation, because of mechanics. The question was never if this gap would close. The question is how long the divergence can persist before convergence is forced. And based on inventory levels, delivery trends, and the rate at which physical premiums are widening, we're looking at quarters, not years. Stay calm, stay informed, watch the indicators. This is how repricing happens when the assumptions behind a market stop holding. Not with a crash, with a slow, controlled unraveling that reveals itself one spread widening at a time. And once you see it, you can't unsee it. Claude est une IA et peut faire des erreurs. Veuillez vérifier les réponses.